Cash value life insurance has often been labeled as expensive, but have you ever stopped to ask, expensive compared to what? Hi, I'm Ashley White, and today I want to challenge the myth that insurance is too costly. When you really break it down and compare the costs to other financial tools like managed money, cash value life insurance actually makes a compelling case for being an essential part of your overall financial strategy. Before we dive in, I want to offer you something valuable, the free Taxes, Income, and Long-Term Benefits case study that breaks down all the numbers we'll be covering in today's video. It walks you through the exact side-by-side comparison that I'm going to go over in the video today between managed investment accounts and cash value life insurance. And it gives you deeper insights into how this strategy can fit into your estate and retirement plan. If you're someone who likes to see the details in black and white, this case study is for you. Stick around for the full discussion, but don't forget to download the information by clicking on the link in the description below. Now let me be clear. I'm not suggesting that you abandon working with a money manager. Having a financial professional guide your investments is a smart move, especially if you're not deeply familiar with the finance world. But what I am saying is that when you add cash value life insurance to your portfolio, it can significantly boost your financial well-being when done right. That's why it's worth exploring how this type of insurance could fit into your broader financial plan. To really dive into this discussion, we need to look at the numbers. That's exactly what I've prepared for you today. It's a visual breakdown of the costs and benefits you can expect from both scenarios. My goal is to take something that might seem complex and make it easy to understand. All right, let's begin. Let's base our example on a 40-year-old man who plans to contribute $20,000 a year starting now and continuing until he's 66 years old. His goal is to ensure that by his normal retirement age of 67, he's able to begin drawing retirement income. For the managed money scenario, I'm assuming a 6.5% rate of return with a portfolio turnover of 25% each year and a wealth management fee of 1.25% annually. I'm also factoring in a conservative tax rate of 22%. Now, there are two key costs you need to keep in mind when it comes to managed money. One, the cost of taxes on the earnings. Remember, Uncle Sam is going to take his share, especially when those earnings are tax deferred. And second, the cost of working with a money manager. These professionals charge fees directly from your portfolio as part of their compensation. And while it's a fair price to pay for their expertise, it's still a cost that impacts your bottom line. Unfortunately for consumers, the cost of working with a money manager is often overshadowed by taxes due on the portfolio turnover and distributions. That's why taxes should always be a significant consideration in your financial planning. Before we dive into the graphical representation of these figures, let's address the common perception that life insurance is expensive. So I'll ask you, expensive compared to what? What are we comparing it against, right? When we invest the same amount of money in a tax-deferred account, we're not just growing our savings, we're also accumulating costs like fees and taxes. Now, as you look at this graph, you'll notice that the combined costs of taxes and fees in a managed account are substantial. By the time the client reaches age 70 years old, his total costs incurred in the managed money account are 120% higher when compared against a life insurance policy. With a life insurance contract, especially something like an IUL, there's often a higher upfront cost. This is why you see in our graph that the insurance contract is more expensive during the first 10 years or so. However, over time, these internal costs decrease. This happens because the insurance contract is front-loaded, meaning the majority of the expenses are charged in the early years. So while it might seem like you're paying more initially, the long-term cost efficiency of an IUL can actually be a significant advantage. As those internal costs reduce, the overall expenses become much lower compared to what you'd continually pay in taxes and fees on a managed account. You might be wondering, how can the difference between these two financial tools be so dramatic? The answer lies in the tax efficiency of life insurance. The IRS allows the cash account inside of a life insurance policy to grow tax deferred, just like a managed account. But there are key differences: how the dollars are taxed and when they're dispersed. With a managed account, the gains are taxed immediately, either as a long-term or short-term capital gain. However, cash value life insurance plays by a different set of IRS rules. First and foremost, life insurance is FIFO, which stands for first in, first out. This means that the dollars you've paid into the contract, your contributions, also known as your basis, are the first dollars to be dispersed. This is an important distinguisher because the dollars you paid in, they were already taxed. So the IRS is not going to tax these same dollars again. So now you should be asking yourself, why is this so significant? Well, all other financial products must adhere to LIFO IRS rules, which stands for last in, first out. With LIFO, the last dollars added, your tax-deferred gains, are the first to be withdrawn and therefore must be taxed. That's why managed accounts are taxed right away when you take the money out. But with cash value life insurance, you don't face taxes until you've withdrawn all your basis and begin accessing the gains. This difference in how the IRS treats withdrawals can make a huge impact on your overall tax liability. And it's one of the reasons why life insurance can be a more tax-efficient way to build and access wealth. So now you're thinking, okay, well, once I've dispersed all my tax-deferred gains, I'll now be required to pay taxes, and usually the answer would be yes. In a cash value life insurance policy, if your disbursements were considered withdrawals, this would certainly be the case. But taking policy withdrawals is actually the least common method in which policy owners access cash value. Accessing cash value can be accomplished on an even more tax-efficient basis, doing so through policy loans. Accessing cash from a life insurance policy by way of policy loans ensures that the dollars you receive are 100% tax-free. Additionally, because the cash is accessed as a loan, technically, the cash value never leaves the policy. This is an important distinction because it allows the funds physically inside the contract to remain inside the contract, allocated to the index, and continuing to compound in a tax-deferred environment. So what happens to the loan? When death occurs, the death benefit that pays out to your beneficiaries is reduced by the loan plus interest that's accrued over time. Let's flip over our screen to the graph for a second. Here's a look at the growth of the two accounts pitted against each other. The purple line represents the managed money account. The pink line is the IUL, and the orange line is the death benefit. As you can see, the managed money and the IUL cash accumulation growth is comparable for the first 15 years, even though the managed money account is assuming a higher rate of return over the IUL at 6.5%. When the IUL starts to take off, this is where the internal costs of the contract have started reducing significantly. At the age of 66, the account value of the managed money account is $947,788, while at the same age, the IUL's cash value has grown to $1,144,753. Because the IUL has grown more dollars, we can take a higher income over retirement years. For this graphical representation, I have the same amount of money coming out of the IUL as I do for the managed money account, $91,356 per year. And what we see is the money from the managed account runs out at the age of 79, whereas the IUL continues paying to the age of 90 years old. So there you have it. Cash value life insurance, particularly something like an IUL, isn't just another expense. It's a strategic component of a well-rounded financial plan. While it might seem costly up front, the long-term benefits, especially the tax efficiency, can be a game changer for your financial future. And by adding cash value life insurance into your portfolio, you're not just diversifying your investments, you're setting yourself up for greater financial stability and tax advantages down the road. It's not about replacing your managed accounts, but complementing them with a tool that offers unique tax benefits. Remember, the goal is to protect and grow your wealth efficiently. And when done right, cash value life insurance can play a crucial role in achieving that. If you're serious about maximizing your financial well-being, it's worth exploring with me how this insurance-based investment strategy can fit into your overall portfolio. If this video got you thinking differently about life insurance, then you'll definitely want to check out the free case study that I've put together called Taxes, Income, and Long-Term Benefits. It expands on everything that we've covered here today. Real numbers, visual comparisons, and practical takeaways that can help you and your family make smarter, more strategic plans. Just click the link in the description to download it below. And if you found this video helpful, hit the like button. Subscribe for more breakdowns like this and tap the notification bell so you never miss an update. Thanks for watching. And remember, your financial future is in your hands. The earlier you start, the longer horizon you have to compound your wealth. So move swiftly to make it count.